Friends, thank you for being here today. I need you to listen very carefully to what I am about to tell you, because what I am going to share with you is not theory, it is not speculation, and it is not conspiracy. It is law, written law, codified law, and it contains a date that should terrify anyone holding Canadian dollars, anyone with a mortgage at a Canadian bank, anyone with a pension invested in Canadian financial institutions. That date is June 30th, 2026. And on that date, unless something extraordinary happens, the legal authority for every major bank in Canada to operate technically expires. This is not hyperbole. This is not a doomsday fantasy. This is Section 21 of the Bank Act of Canada. And here's the part nobody expects. In roughly 140 days, the entire Canadian banking system reaches what I call its best before date. The invisible clock is already ticking, and this part has already begun. Now, most people have no idea this provision even exists. Most people assume that banks like the Royal Bank, TD, Scotiabank, the institutions we've trusted for generations, operate on some kind of permanent charter. But that assumption is wrong. The Canadian banking system does not run on permanence. It runs on permission, parliamentary permission, and that permission must be renewed every 5 years. This is the mechanism hiding in plain sight. Let me be precise. The Bank Act contains what is known as a statutory sunset provision. It is a legal requirement that forces Parliament to periodically review and reauthorize the entire regulatory framework governing banks, insurance companies, and trust institutions. The current sunset date, June 30th, 2026, was set during the last legislative extension. And here's where the clock actually starts. If Parliament fails to pass renewal legislation before that date, the statutory authority for these institutions to carry on business under federal law vanishes, not metaphorically, legally. Now, you might be thinking, this sounds like a formality. Surely Parliament will just pass the extension like they always do. And historically, you would be right. This renewal has occurred roughly every 5 years since the early 1990s. It has passed under Liberal governments. It has passed under Conservative governments. It has passed during majority governments and minority governments. In previous cycles, the extensions were passed months before the deadline. Clean, procedural, boring, but this is not a previous cycle. This is where common sense actually becomes your enemy. Because what we are facing today is not the Canada of 2016 or 2011 or 2006. We are facing a Canada in the grip of extreme political gridlock, a minority government teetering on collapse, a parliament that has been paralyzed by procedural warfare, and a global trade environment where tariffs and economic retaliation are escalating in real time. We are facing a scenario where the formality, the procedural certainty, the boring legislative housekeeping that everyone assumes will happen might not happen. And here's the part that scares me. We don't have months. This is happening in days. Let me show you what actually happened. The Department of Finance typically begins consultation on these renewals well before the expiry date. They engage with industry stakeholders, consumer groups, regulatory bodies. It is supposed to be a methodical, transparent process. But in a climate of political chaos, where Parliament can be dissolved at any moment, where confidence votes are looming, where the very legitimacy of the governing coalition is under siege, that methodical process becomes fragile. And this is where the first domino falls. Because if Parliament is dissolved before the extension is passed, if an election is called and drags on, if the new Parliament is delayed in convening or is paralyzed by its own fragmentation, the June 30th deadline becomes an actual threat, not a theoretical one, an observable one. And once this shifts, everything above it starts to shake. Now, here's the detail even analysts tend to miss. Section 21 of the Bank Act does not just say banks need to follow the rules. It says banks are restricted from carrying on business except as authorized under the Act. Read that again, except as authorized under the Act. If the Act expires without renewal, the federal authorization evaporates. The Big Six, TD, RBC, BMO, Scotiabank, CIBC, National Bank, these are not just big companies. They are federally chartered institutions. Their very legal existence is tied to this statute. Without it, they operate in a legal gray zone, and markets do not tolerate gray zones. But that's not the real problem. The real problem is what happens in the 72 hours before that deadline, if there is any uncertainty. Because markets move on perception, not reality. If credit rating agencies begin to signal that legislative failure is possible, if international investors begin to see governance break down, if the Canadian dollar starts to wobble because the rule of law itself is in question, you get a cascade. And here is where the cascade becomes unstoppable. Let me walk you through the forensic evidence. This is not the first time a sunset clause has created systemic risk. In the United States, debt ceiling standoffs have repeatedly pushed markets to the edge, not because default actually occurred, but because the possibility of default was entertained. In 2011, Standard & Poor's downgraded U.S. sovereign debt for the first time in history, not because the U.S. was insolvent, but because the political system demonstrated it was willing to flirt with insolvency. The damage was done before any technical default occurred. Canada is not immune to this logic. And this is where everything changes. Because if Parliament is stalled, if the legislative calendar is consumed by political theater, if June 30th arrives and there is no renewal, even for a single day, the legal ambiguity alone would trigger chaos. Institutional investors would pull back. Credit default swaps on Canadian sovereign debt would spike. The currency would crater. And here's what that looks like on the ground. Your mortgage rate, which is priced off the credit worthiness of your bank, which is priced off the stability of the regulatory framework, would spike. Not because your bank is insolvent, not because you missed a payment, but because the legal scaffolding holding the entire system together has developed a crack, and this is the crack that becomes an earthquake. Now, let me show you the mechanism. Under normal circumstances, Parliament could pass a simple extension bill. It is typically procedural, not controversial. A few clauses, a few votes, done. But we are not in normal circumstances. We are in a parliament where procedural motions have become weapons, where opposition parties are incentivized to obstruct, where the government's legislative agenda is perpetually on life support. And here's the part the experts gloss over. If Parliament is dissolved before the deadline, the government cannot pass the bill. They have to reconvene after an election, and elections take time. Campaigns take time. Forming government takes time. And time is the one thing the June 30th deadline does not give you. This part is non-negotiable. If the deadline passes without renewal, the statute expires. Period. Now, could the government invoke emergency measures? Possibly. Could they issue some kind of interim order under federal powers to maintain continuity? Maybe. But those are untested mechanisms. Those are desperate measures. And markets do not wait for desperate measures to resolve themselves. Markets front run the chaos. Let's cut through the noise. What would actually happen in a worst-case scenario? Here's the sequence. First, a temporary legal uncertainty arises. The banks do not shut down at midnight like some kind of Y2K bug, but their statutory authority becomes ambiguous. Second, the markets react immediately. Bond yields on Canadian government debt spike. The Canadian dollar sells off. Credit spreads widen. Third, credit rating agencies issue warnings. They do not downgrade immediately, but they put Canada on negative watch. Fourth, institutional capital begins to flee. Pension funds, sovereign wealth funds, foreign investors, they do not wait to see how it resolves. They de-risk. They rotate into safer jurisdictions. And once that rotation begins, it feeds on itself. This is vanishing in real time because the moment investors perceive that Canada's governance structure is unreliable, that the rule of law is negotiable, that the political class is too dysfunctional to pass basic housekeeping legislation, confidence evaporates. And confidence is the only thing holding modern financial systems together. Now, let me be very clear about something. The Bank of Canada itself operates under a separate statute. The Bank of Canada Act is distinct from the Bank Act governing commercial banks. So the central bank, the lender of last resort, the institution that manages monetary policy, does not cease functioning if the Commercial Bank Act expires. But here's where the domino sequence accelerates. If the big six banks lose their statutory authorization, even temporarily, the Bank of Canada's ability to transmit monetary policy through the commercial banking system is crippled. You cannot run a modern economy when the transmission mechanism is legally compromised. And this is where the tension reset happens, because what I'm about to tell you is worse. The Canada Deposit Insurance Corporation, CDIC, which insures your deposits up to $100,000 per insured category, operates under its own statute as well. So technically, your deposits remain insured even if the Bank Act lapses. But here's the counterintuitive pivot. Insurance is only as good as the system's ability to honor it. If the banks themselves are operating in a legal twilight zone, if withdrawals surge because depositors panic, if liquidity freezes because interbank lending collapses due to legal uncertainty, the CDIC's promise becomes academic. You have insurance on a house that's on fire, and the fire department is stuck in traffic because the roads have no legal status. Let me show you what's really behind it. Canada's banking system is built on a principle called federal chartering. Unlike the United States, where you have state-chartered banks and federally chartered banks operating side by side, Canada's major institutions are exclusively federal creatures. They exist because the Bank Act says they exist. They have powers because the Bank Act grants those powers. Their ability to take deposits, issue loans, clear payments, all of it flows from federal statutory authority. This is the big secret of the entire system. Canadian banks are not just regulated by federal law, they are constituted by federal law. And here's the moment the clock actually starts. When you strip away the legalese, what Section 21 really says is this: without the Act, you don't have banks. You have corporations that used to be banks, and corporations that used to be banks cannot access the payment clearing system. They cannot access the Bank of Canada's standing facilities. They cannot participate in the overnight lending market. They become, in essence, financially isolated entities operating on borrowed time and borrowed credibility. Now, this is not theoretical, this is math. Let me walk you through the numbers. The big six banks hold approximately $3.4 trillion in total assets. That's trillion with a T. Those assets include mortgages, business loans, consumer credit, government bonds, and a staggering amount of derivatives exposure. If the legal framework underpinning those institutions becomes ambiguous, even for a week, the mark-to-market value of those assets becomes uncertain. And uncertainty in a $3.4 trillion portfolio is not a rounding error. It is a systemic event. Here's what that looks like on the ground. For the average household, this means your mortgage, which you assume is a stable 30-year contract with predictable payments, suddenly exists in a legal gray area. Now, does that mean the bank can void your mortgage? No. Does it mean you can stop paying? Also no. But it does mean that the securitization market, where your mortgage is bundled with thousands of others and sold to institutional investors, freezes. Because institutional investors do not buy securities whose underlying legal status is in question. And when the securitization market freezes, the banks cannot offload mortgage risk. And when they cannot offload risk, they stop writing new mortgages. And when they stop writing new mortgages, the housing market collapses. But we haven't even reached the breaking point yet, because here's where it gets truly catastrophic. The big six banks are not just domestic institutions. They are globally interconnected entities with massive cross-border exposures. They borrow in US dollar markets. They participate in the London Interbank offered rate system. They hold sovereign debt from dozens of countries. They are counterparties to trillions in derivative contracts. And all of those relationships, all of those obligations are predicated on the assumption that these institutions are legally authorized, federally regulated, and systemically stable entities. If that assumption breaks, even slightly, the contagion spreads globally. Here's the part nobody expects. Foreign banks that have lent to Canadian banks, that have entered into swap agreements with Canadian banks, that have taken Canadian bank debt as collateral, they start issuing margin calls. They demand additional collateral. They refuse to roll over short-term funding. And because modern banking runs on overnight funding, on the assumption that liquidity is always available, a sudden funding freeze is a death sentence. Let me be precise about the timeline. In 2008, Lehman Brothers collapsed, not because it was insolvent in the traditional sense, but because it lost access to short-term funding. The moment counterparties refused to lend to Lehman overnight, the firm had to liquidate assets at fire sale prices to meet obligations. That liquidation created a downward spiral. Asset prices fell, margin calls increased. More liquidations, more price declines. Within 72 hours, Lehman was gone, and Lehman was a single institution. We are talking about the potential legal ambiguity surrounding the entire Canadian banking system. The scale is incomprehensible. Now, here's the insider signal. What I call the hidden architecture of modern finance is not capital. It is not reserves. It is confidence in legal continuity. Every transaction, every loan, every derivative, every bond issuance is built on the assumption that the legal framework will be there tomorrow, that contracts will be enforceable, that regulators will have authority, that institutions will have charters. When that assumption is threatened, the architecture does not bend, it shatters. And this is where the certainty frame comes in. This part isn't a prediction, it's observable. We can already see the warning signs. Political gridlock in Ottawa is at historic levels. The minority government is clinging to power by procedural gimmicks. The opposition is openly calling for elections. The global trade environment is deteriorating with tariffs escalating between the US and Canada. The legislative calendar is clogged with symbolic motions and political theater. And in the middle of this chaos, there is a statutory deadline, June 30th, 2026, that requires functional governance to address. But that's not the part that scares me. The part that scares me is the normalcy bias. Human beings are hardwired to believe tomorrow will look like yesterday. We assume that because the sunset clause has been renewed 9 times before, it will be renewed a 10th time. We assume that because Parliament has always functioned well enough to pass basic legislation, it will continue to function. We assume that because Canada has never experienced a governance breakdown of this magnitude, it never will. But assumptions are not analysis. And history is littered with the wreckage of systems that collapsed because everyone assumed they were too stable to fail. Let me show you the precedent. In 2011, the United States came within hours of breaching its debt ceiling, not because the country was broke, but because Congress could not agree on a procedural vote. The markets did not wait to see if they would resolve it. Treasury yields spiked. Equity markets sold off. The dollar weakened. And that was just the possibility of a technical default on a specific class of debt. We are talking about the potential expiry of the legal framework for an entire banking system. Here's the part they never put in the official reports. Even if Parliament eventually passes the renewal, even if they do it at the last minute, even if they cobble together some emergency session and push it through on June 29th, the damage will already be done because the market will have seen the dysfunction, the market will have seen the Brinkmanship, the market will have seen that Canada's political class is willing to gamble with systemic stability for partisan advantage. And once that perception sets in, it does not reverse easily. This is a default in all but name, because when investors lose confidence in the governance structure, they do not wait for technical default to occur. They price in the risk immediately. Canadian sovereign debt yields rise, the currency weakens, capital flows reverse, and the cost of that risk is borne by every Canadian. Your mortgage rate goes up, your credit card rate goes up, the price of imported goods goes up. Your pension, if it holds Canadian bank stocks or bonds, loses value. The entire economy contracts because the political system failed to perform basic maintenance. And here is where the cascade becomes unstoppable, because once the contagion starts, once international capital begins to flee, once the currency is in free fall, the government's options narrow dramatically. They could intervene. They could try to stabilize the currency through foreign exchange operations. They could try to backstop the banks with emergency liquidity. But all of those measures require credibility. And credibility is the one thing they will have just destroyed by failing to renew the Bank Act on time. Let's cut through the noise again. I want to be very clear about what I am not saying. I am not saying the banks will shut down on July 1st, 2026. I am not saying your deposits will vanish. I'm not saying ATMs will stop working. What I am saying is that the legal ambiguity, the governance failure, the perception of dysfunction will create a crisis of confidence. And in modern finance, confidence is everything. Now, let me take you back to where this mechanism was born, because to understand why this sunset clause exists, you have to understand the history of Canadian banking regulation. In the early 1990s, Parliament decided that the financial services industry was evolving too rapidly to be governed by static legislation. Technology was changing, global capital flows were changing, the risks were changing, so they built in a mandatory review process. Every 5 years, Parliament would be forced to revisit the Bank Act, the Insurance Companies Act, and the Trust and Loan Companies Act. The goal was modernization. The goal was to ensure that capital rules, competition rules, and consumer protections kept pace with reality. It was, in theory, a brilliant piece of legislative architecture. But here's the counterintuitive pivot. What was designed as a safeguard has become a vulnerability because the Sunset Clause assumes a functional parliament. It assumes a political class capable of setting aside partisan warfare long enough to pass housekeeping legislation. It assumes that the institutions of governance are resilient enough to meet deadlines. And those assumptions in 2026 are no longer safe. Let me show you what I mean. In previous cycles, the Department of Finance would begin consultations 18 months before the deadline. They would issue discussion papers, they would hold stakeholder meetings, industry groups would submit recommendations, consumer advocacy groups would weigh in. The process was transparent, inclusive, and methodical. By the time the legislation reached Parliament, it was a polished, consensus-driven bill. There was no drama. There was no uncertainty. It passed with broad support. But this time, the timeline is compressed. This time, the political environment is toxic. This time, the governing party is fighting for survival. And this time, the opposition parties have every incentive to weaponize the process, not because they want the banks to fail, but because forcing the government into a crisis, forcing them to beg for cooperation, forcing them to make concessions is political leverage. And in a minority government, leverage is currency. Here's the moment the countdown quietly began. When the last extension was passed in 2021, the political landscape was different. The Liberals had just won a strengthened minority. The economy was recovering from COVID lockdowns. The opposition was fragmented and demoralized. Passing a 5-year extension was a formality, but that 5-year clock has been ticking. And now, in early 2026, with the government weakened, with Parliament paralyzed, with an election looming, that formality has become a flashpoint. And here's where the micro cliffhanger hits. Because even if the government tables the renewal legislation tomorrow, even if they make it a priority, the opposition can delay it. They can demand committee hearings, they can propose amendments, they can filibuster, they can tie it up in procedural knots, and every day of delay pushes the system closer to the edge. This is vanishing in real time. Now, let me address the question you're probably asking. Could the government invoke emergency powers? Could they bypass Parliament and issue some kind of executive order to maintain continuity? Technically, the federal government has broad emergency powers under the Emergencies Act, but invoking those powers for a banking sunset clause would be unprecedented. It would signal to the world that Canada's democratic institutions have failed, that the rule of law is no longer reliable. That governance has devolved into autocratic improvisation, and that signal would be more damaging than the problem it's trying to solve. Let me be precise. Markets tolerate a lot of things. They tolerate recessions. They tolerate political turnover. They tolerate policy mistakes, but they do not tolerate the breakdown of constitutional order. The moment a government invokes emergency powers to keep banks legally authorized, every institutional investor on the planet starts asking the same question. If Canada cannot pass routine legislation through democratic channels, what else is broken? And this is where the zoom-in cutaway becomes personal. For pensions, this is catastrophic. Canadian pension funds, CPPIB, Ontario teachers, OMERS, they hold massive positions in Canadian bank equity and debt. If those securities lose value due to governance risk, the funding ratios of those pensions deteriorate. And when funding ratios deteriorate, benefits get cut, contribution rates go up, retirement security evaporates. This is not some abstract market event. This is your future. For small businesses, this is existential. If the banks stop lending because the legal framework is in question, if lines of credit are frozen, if merchant services are disrupted, businesses that operate on thin margins, that rely on credit to manage cash flow, they collapse. Not because they're poorly managed, not because demand dried up, but because the legal infrastructure of commerce has been compromised. Here's the part where I need you to understand the convergence. We are not facing a single threat. We are facing three distinct forces hitting at once. First, the structural break in Canada's political system. The minority government is unsustainable. The opposition is radicalized. The legislative process is weaponized. Second, the domestic economic fragility. Household debt is at record levels. The housing market is overextended. Consumer spending is weak. The economy cannot absorb a financial shock. Third, the global context. U.S. tariffs are escalating. Trade relationships are fracturing. The Canadian dollar is under pressure. Foreign investment is retreating. And into this convergence, we inject a statutory deadline that requires functional governance to address. This is the trifecta. This is the moment where all the fault lines intersect. Now, let me talk about what you can actually do, because this is where the psychological pivot happens. You cannot control Parliament. You cannot force them to renew the Bank Act. You cannot will the political system into competence, but you can control your exposure. You can control how you position yourself in the line of fire. Here's the binary choice. Do you own assets or do you own claims on assets? Do you hold physical gold or do you hold a gold ETF? Do you own land or do you own a REIT? Do you hold cash in a bank account or do you hold cash equivalents that exist outside the Canadian banking system? These distinctions, which seem trivial in normal times, become life or death in a crisis. Let me show you what actually happened in previous banking crises. In Cyprus in 2013, when the banking system was on the verge of collapse, the government imposed capital controls. You could not withdraw more than a few €100 per day. Your deposits were frozen. Your wealth was trapped. The people who survived that crisis were the ones who had moved capital offshore before the controls were imposed. The people who suffered were the ones who assumed it couldn't happen, who trusted the system, who waited too long. This is not a conspiracy. It is a stated reality. When systems break, governments protect the system, not you. They will freeze deposits. They will impose withdrawal limits. They will bail in creditors. They will do whatever it takes to stabilize the institution, and they will do it at your expense. So here's the call to action. If you hold significant deposits in Canadian banks, diversify. Move some capital into foreign accounts. Move some capital into physical assets, gold, silver, land, commodities that exist outside the banking system. I'm not saying liquidate everything. I'm not saying go off grid. I'm saying reduce your exposure to a single point of failure. If you hold Canadian bank stocks in your portfolio, understand the risk. Understand that governance failure is now a material risk factor. Understand that the legal ambiguity surrounding the June 30th deadline is not priced in. The market is operating on the assumption that this will be resolved smoothly, and assumptions are not investments. Here's the money illusion at work. Your portfolio might show gains. Your net worth might look impressive. But if that wealth is denominated in a currency that's collapsing, if it's held in institutions whose legal status is compromised, if it's tied to a system that's unraveling, you're not wealthier. You're just holding a bigger number in a depreciating unit of account. You become a millionaire on paper, but poorer at the grocery store. And here's the final resonance. The question is not whether this sunset clause will be renewed. The question is whether it will be renewed smoothly, with confidence, with competence, or whether it will be renewed at the last minute in chaos, with markets panicking and capital fleeing, because even if the outcome is the same, the path matters. The path determines who wins and who loses. The path determines who saw it coming and who got caught off guard. Let's cut through the noise one last time. This is not about predicting the future. This is about preparing for volatility. This is about understanding that systems we take for granted, systems that have worked for decades, can break when the underlying assumptions change. And the underlying assumption that Canada's political class is capable of basic governance is changing. History favors the prepared, and the window for preparation is closing. In 140 days, we will know whether Parliament renewed the Bank Act in time. We will know whether the political system is still functional. We will know whether Canada's reputation as a stable, well-governed jurisdiction is deserved or was just a legacy assumption that outlived its validity. But by the time we know, it will be too late to act. The people who move now, who reduce their exposure now, who diversify now, they will be fine. The people who wait, who assume it will all work out, who trust the system to self-correct, they will be the ones left holding claims on a system that no longer exists. So I'll leave you with this. The Canadian banking system has a best before date, June 30th, 2026. And unlike the milk in your refrigerator, this date is not a suggestion. It is the law. The question is whether your elected representatives understand the stakes, whether they understand that this is not routine, whether they understand that the world is watching. Because if they fail, if they allow this deadline to become a crisis, the consequences will not be borne by them. They will be borne by you, by your savings, by your pension, by your future. And when it happens, when the confidence evaporates and the system convulses, the only question that will matter is whether you saw it coming. Friends, thank you for being here. History is unfolding, and this time we have a date.